Good morning, everyone, and welcome to our Chester County Chamber headquarters for what is now becoming, Chesco Chamber TV. Today's presentation is on Economic Forecast 2.0. In this very unusual year, we're having yet another unusual event. While typically we would have our economic forecast events in January, and all of our analysts would have an opportunity to collect data, discuss with one another, and take a thoughtful look ahead, this year, due to all these unforeseen circumstances, from the pandemic to the lockdowns and the reopenings and all that's taking place, we felt it was appropriate as a chamber to pause this fall and think about where we are and what the road ahead looks like for the economy at large and different sectors of the economy and how it will impact us. Less than a year ago, our chamber board of directors met with our region's economic leaders and elected officials. The number one issue confronting us was a workforce shortage. Our unemployment rate was less than 3%. We could not fill the roles needed to keep this economy that was roaring hot to keep it going forward. We find ourselves less than a year later with about 10% unemployment in our county and a higher unemployment rate across the state. Things are very different. So we'd all like to know from people we can trust, from institutions we can trust, where are we? And what's the road forward? What is the opportunity for growth, and are there still bumps in the road as we move forward? We are fortunate today to have a number of thoughtful analysts, people who understand the economy, to help us as a chamber, to help us as a region move forward. As we assemble today, I want to first thank our sponsors from our board of directors. There are so many people whose financial support made this event possible, and as you'll see throughout the program and in our thank you, there are a number of companies. I also want to thank Valley Creek Productions for making this event possible and broadcasting it to you. To begin today's event, we have a number of speakers. First, let me recognize them. You'll hear later from our moderator, Kim Brumbaugh of Brumbaugh Wealth Management. We also have two panelists with us here live. First, we have Andrew Patterson of Vanguard and Dan White of Moody's Analytics. We are so blessed as a region to not only have a thriving economy, but two worldwide respected institutions in our own backyard with a wealth of information and talent to share with us in our region. But to begin today's program, our first presenter will be Luke Tilley. Luke is an analyst and the chief economist at Wilmington Trust, a part of the M&T Bank family. Luke is going to share his keynote perspective on where we are in the economy, and then we'll return back here for a discussion moderated by Kim. With that, I'm going to turn it over to a pre-recorded message that Luke was kind enough to make for us. He's sharing our keynote remarks this morning. So ladies and gentlemen, I will turn it over to Luke Tilley from Wilmington Trust.
Thank you to the Chamber for having me here for this event. I'll start off by saying that at Wilmington Trust, we're taking sort of a short-term view and then also a longer-term view when we think about the economic outlook. And that we're a little bit cautious in terms of when we look at the next couple of months ahead. So we have been extremely encouraged by the strong figures that we have seen in terms of macroeconomic data over the past couple of months. The strong bounce in retail sales have actually surpassed pre-COVID levels, and jobs, although we're only roughly halfway back to where we were before, have been picking up fairly quickly, and the hiring over the past 4 months has been encouraging. We'll have to see this coming Friday what that jobs report entails. Now, when I say we're cautious, it's because although we're encouraged by those figures, we recognize that it has been slowing down a little bit. Retail sales have been gaining, as I said, but slower and slower with each month. And that's the truth with hiring as well. And there are a few indicators that hiring might be even slowing and coming to a halt at a point where we are still 9 or 10 million jobs in the hole compared to pre-COVID. So when we look forward for the second half of this year, we think the two biggest drivers for the economic outlook are both fiscal stimulus and the path of the virus. So in terms of the path of the virus, we know that the numbers are starting to pick back up in the US in terms of cases, and we've seen them pick up back up in Europe. And we know from the summertime that when cases pick up, it tends to affect economic activity, even if there are no restrictions put in place. We've seen in the South and the Southwest, in some of those states that had the rapid run up in July, even before those restrictions were put in place, people started staying home, going out less and spending less money, and that certainly affects the outlook. And it's frankly unpredictable what's going to happen with the virus. But encouragingly, we do have vaccines that appear to be well on track to be available later this year and possibly widely distributed in the first or second quarter of next year. So again, the virus is very unpredictable, but it gives us some caution. On fiscal stimulus, we think that another round of fiscal stimulus is required and would be critical to continue having the strong spending numbers that we've seen and the job growth numbers. And I should say that that's not an endorsement. We're not at Wilmington Trust saying that we should or should not do fiscal stimulus. We're just recognizing that the very large amounts of fiscal stimulus, hundreds of billions of dollars that were sent out as a result of the CARES Act, are no longer being sent out now. That is what generated such strong spending gains over the past several months. And we don't think that the economy can continue to post those gains without another round of stimulus, given where the labor market is. Again, it's not an endorsement of doing more stimulus. We're just saying that if there was not another round, we would expect retail sales to move back downwards and that we'd start to see some weakening. So we await to see what happens in terms of the fiscal stimulus and try not to make any predictions about what's going to come out of Washington, D.C. So in the near term, we recognize, as I said, that slowing down of employment growth and also the slowing down of retail sales, and it's contingent upon the virus and stimulus. We're a little bit cautious because we don't know how those things are going to turn out. And in terms of the rate of growth after this, we're a little bit more on the pessimistic side. As I said, we think about the long term and the short term at Wilmington Trust. And the long term, it gets really interesting, because we don't think that we're going back to the same economy that we had pre-COVID, not ever. We might get back there in terms of GDP or in terms of total number of jobs fairly quickly, but it's going to be a very different economy. And that's because, as we like to say, recessions have a way of accelerating trends that were already in place. That's been the truth over previous recessions. That's going to be the truth in this recession. And we think especially in this recession. So not to go too far back in time, but we know that technologies take a long time to be adopted, even if it's apparent to the world that they could be changing for economies and for people's lives. For instance, the electrification of manufacturing firms. After 30 years, only half of firms had taken on electricity after it had been well developed. Computers took decades to be widely adopted. Even online shopping became available in the mid-1990s. And of course, it wasn't until more recently that Amazon and a wider array of online shopping options have become more prevalent. In the current recession and in the current recovery, what we expect to see because of this acceleration of trends that were already in place are items like we're doing right now, talking on Zoom. Zoom actually, the firm started in 2011. Lots of other video chat meeting software was available before COVID. It was slowly being adopted by firms. And now, I think it's obvious to everybody, we're never going to go back to a time where people don't know how to use it. And that can have ramifications for companies, how much travel they are going to do in terms of corporate travel, meetings, the amount of real estate that they need for offices. It might be the case that a lot of people are working from home more days a week than they ever were before COVID. And it's just a small way of thinking about the structural changes that have probably hit our economy. So when we think about that, and you try to think about those examples that I used before about electrification or the computer or online shopping, which are very familiar, think about the technologies that have been developed and that you see in TV shows and you say, wow, that's neat, but how's it going to change the economy? Things like robotics, artificial intelligence, the Internet of Things, big data, cloud computing. All of those things, which are being kind of neat, or if you think about a long time ago, decades ago, or 100 years ago, a manufacturer saying, wow, that electricity is really neat, but I don't know when I'm going to adopt it. That new list of things is going to be adopted fairly quickly in terms of relative to if we did not have this recession. So when we think about that long-term impact at Wilmington Trust, it's going to be a rapid adoption of those technologies. But history also shows us that it tends to be a little bit painful on the labor market side, because as firms decide to take on new technologies, they readjust the amount of capital investment they have relative to the amount of labor, And it can be a painful transition for jobs as jobs get lost and they need to be created with new firms. And the more optimistic side of that, of course, is that it presents incredible opportunity for businesses who want to step into that void, who want to take on new technologies, really rethink the way that they serve their customers, the kind of products they produce, the way they meet, the way that they engage with their customers. And it also presents opportunity for people either returning to school or for recent college graduates or people going into college and thinking about the kind of industries they want to be in. So again, at Wilmington Trust, in the short term, we think that the path of the economy is highly contingent on two very unpredictable things: stimulus, this fiscal stimulus, and also the path of the virus. And over the longer term, we're expecting some truly fundamental changes to the way that our economy operates, and that presents both challenges and opportunities. So once again, thank you to the Chamber for letting me present to you here today, and I'm going to pass it back over to Kim Brumbaugh.
Good morning. I'm Kim Brumbaugh of Brumbaugh Wealth Management. Our firm is located in Exton with offices in Berwyn and soon to be Florida. I am a member of the board of the Chester County Chamber as well as a former chairperson. We wanted to note this morning, just before we get started, to feel free to use the chat option in the program, as we will be collecting questions throughout the discussion. We want to thank Vanguard and Andrew Patterson for being with us this morning as part of our panelists, and Dan White from Moody's Analytics. So welcome, gentlemen. We appreciate you being here.
Thanks for having us.
So for our first question this morning, do you believe the biggest changes to the economy have already occurred or have not yet occurred? And what is that change in your opinion? Andrew, would you like to take that first, please?
Happy to. So, we hope we've seen, the biggest impacts to the economy to date. This is a health crisis, so it evolves and changes, so we can't know for certain. Nothing in economics or forecasting is certain, but we place a reasonable degree of certainty around the idea that going forward, we hope that a lot of the impacts that we're seeing to date, the impacts on our lives are going to abate over time. One of the things that's likely with us to stay, though, is the work from home, right? It's been a huge shift. For those of us lucky to do so, it's been a real change to our working lives and our home lives as well. It's created some opportunities. I have a 2-year-old son at home, so it's created an opportunity to see him, but also some challenges as well, right? So I would say in terms of longer-term implications, we don't really have the data yet on what work from home is doing in terms of impact on productivity, whether it's increasing it or decreasing it, but over time we'll start to get those numbers and understand better what that means. There'll likely be a period of transition where people go back into the office, but longer term we're unlikely to go back to, in most industries, the 5-day work week expectation to be in the office. And we will have to wait and see how that impacts productivity over time, and those implications could have real meaningful impacts on longer term growth.
Okay. Dan, what are your thoughts?
Well, I think we're kind of going to continue to see change. I think we're right in the middle of change, and things are going to continue to progress and change. Not just in terms of how we're working, but in terms of how we're interacting with the economy. I think consumer behavior is one of the things that people are maybe overlooking a little bit, because we're all at home with, I've got 4 boys at home. I'm basically running an all-boys boarding school at this point, so I haven't had as much chance to think about it as you have. But the way that we consume things is different. We're finding ways around the business restrictions. We're finding ways to conduct that kind of economic activity that we had before. It's just in a different way, and some of that is going to last for a very long time. My wife really enjoys having somebody bring the groceries to the house because she doesn't have to take 4 boys to the grocery store. That's something that's going to keep up. And the way that businesses are adapting to that and those changing consumer behaviors is going to, I think, dictate a lot of the winners and losers over the next 2-3 years as we come out of it.
Yeah, certainly interesting times, and it will be interesting to see how all of that impacts in the future. So do you think that 2021's economy will be more closely resemble 2020 or 2019? Dan, you want to take that one first?
I think it'll look like 2021. I think it's going to be its own kind of animal. I think it's going to probably resemble 2020 in at least the second half of 2020, in that it's going to be a while before we really start to see a genuine recovery out of this. until we have a vaccine that is widely distributed and accepted, that people are willing to take, I don't think that even if business restrictions are repealed, consumer behavior is going to change, and just because people can partake in certain activities doesn't necessarily mean they will. And so until that vaccine is developed, is accepted, and enough people have access to it, that need access to it, I think people are still going to be very cautious. And so we probably don't see that full-on recovery. Our baseline forecast at Moody's assumes we don't see that probably until late next summer, so almost this time next year. So that's a long time of basically moving sideways and trying to adapt to this new reality. Beyond that, I think people are going to realize that pandemics can happen, and so they're going to be a lot more cautious, and they're going to change the way that they interact with things going future. So 2021 is going to be a totally different animal than 2019 or 2020.
Okay, thank you. Andrew?
Sure. So we share a similar perspective in that we don't believe the economy is going to get back to pre-pandemic levels of growth or levels of output until probably towards the end of 2021. Right? So what does that mean? That means, in all likelihood, 2021 is probably going to look more like 2019 in that there will be positive growth. It'll look, more like 2020 in that there'll be a lot of uncertainty around that growth. Right now, we've actually just revised up our forecast for 2020, in part due to better outcomes on the demand side. We haven't seen as many business closures on the supply side, so we've actually increased our outlook for Q3 and Q4, but in doing so, pulled some of the growth we were expecting in 2021 into 2020. So as Dan mentioned, 2021 is going to be a much different animal than either 2019 or 2020. In all likelihood, it's going to be better than 2020 was, we hope, right? And you're also likely to see stronger growth than you did in 2019, but that growth rate's likely to ebb back down to a longer-term trend of around 2%, which is right around where it was in 2019. But again, I mentioned before, impacts on productivity. If we start to get a sense that there are positive or negative impacts on productivity, on longer-term growth, then we'll have to really think a little bit harder about probably 2022 and beyond.
So that's interesting, and that's a good segue into our next question, is maybe just drilling down a little bit more on that, is what are your thoughts on those industries that would recover quicker as compared to those that will lag in a recovery as we go forward? Maybe
Sure.
you could comment on that.
Sure, absolutely. So I think we've all seen, the technology stocks and the technology industry, knowing that certain segments of that, Zoom and streaming services, those have been benefiting from the pandemic. You don't like to say anybody benefits from the pandemic.
Of course.
Of course,
Sure.
there are winners and losers in any situation. Face-to-face services, unfortunately, as Dan mentioned before, until consumer behavior gets back to normal, are likely to suffer. So industries that require a lot of human contact, those are likely to lag. And some of them may never go back to normal, unfortunately. But again, we have to wait and see as the data starts coming in. A lot is going to depend on what we term consumer reticence. That hinges a lot on health outcomes. A vaccine is great, but even before you get a vaccine, if people start to feel more confident in going out, if you get better treatments for the virus, if we understand it better, which we do, right? We understand it a lot better than we did in the early days of the pandemic, and they understand what behaviors to avoid, maybe some of those industries come back online a little bit quicker.
Okay. Dan, what are your thoughts around that? Some of the industries that I'll call it have either benefited or have been beneficiaries because of the stay-at-home companies.
Sure.
Versus those that, restaurants and other industries, energy, that might lag going forward.
Yeah, I would echo a lot of what Andrew said, and I would even say within those industries, there's a lot of winners and losers that we're seeing, mostly about adaptability. So if you're, especially some of the large companies who have the resources to adapt to moving things online or making things contactless, they're doing much better, much quicker than some of the other companies in their own industry. What that probably means is we see a lot of consolidation in firms over the next several years as those companies who are doing, and we see that when we come out of any recession. Mm-hmm. But we especially see it coming out of this one because those who were able to adapt early are going to have a huge technological advantage over those who didn't, and that really creates some agglomeration in some of those industries.
That's good. Okay. And with the government's quick response with fiscal and monetary policy providing support with additional unemployment through the CARES Act, we're seeing people in different business circles that are not necessarily returning to work. We know unemployment has taken a turn and there's been some positive reduction in unemployment. But there's still people that are home. I'm personally involved in a couple of business circles where folks are in manufacturing, making windows or window installations, things like that, and they're having a hard time finding people to come back to work. And it seems maybe some folks maybe it's the fear of getting ill, or is it just that they had an additional money coming from the government and they're going to kind of wait to see if there's going to be another round? So maybe you could speak to that a little bit. And again, what's the longer economic impact on that, where we're not necessarily getting people back to work and maybe they're choosing not to?
Sure. Yeah, and those are great points. And I think I would lean that in certain industries, especially construction things, it seems to be more of the fear from a health perspective than it is the enhanced unemployment benefits. Okay. And I only say that because we haven't seen a huge drop off since those enhanced benefits expired in July. And we still have some time to see some data, and we need to see more. We're economists, we always want to see more data.
Sure.
We haven't seen that drop off that we thought. That said, I think if we do have another round of enhanced UI, it should be at a much lower benefit point than it was previously, and I think that'll help get some of those folks in. But what we're seeing, and this is kind of interesting, is that we're seeing a lot of those folks in the labor market still identify as unemployed for temporary reasons, which means that we see that, we feel that they are totally capable and willing to come back into the labor force as time goes on. And it might just be a matter of timing. I mean, we might get far enough back where they're willing to enter the labor force without those enhanced UI benefits. But until they do, their spending power is going to go down a great deal. And so if we don't have that increased fiscal stimulus going over the next 3 to 4 months, we don't have something before the election, it's very possible that going into holiday season especially, disposable personal incomes really fall off because those people haven't re-entered the workforce yet, which is why I think whether or not that bill gets passed is a huge near-term risk for upside and downside to the economic outlook.
Okay. Would like to...
So I think Dan brought up a good point there in terms of the amount of people who identify as being permanently unemployed versus temporarily unemployed, right? You hear a lot about the unemployment rate, you hear a lot about unemployment insurance claims, all data, whether it's labor market related or otherwise, is somewhat skewed because agencies are finding it difficult to sample in the same way that they did in the past. A lot of them relied on in-person sampling, so clearly that's been inhibited to some extent. So what we have to do, using data providers like Moody's Analytics, is try to dig into those reports a little bit deeper, right? And what we see, and what we're starting to see, is an uptick in the proportion of the unemployed that are claiming that they're staying home for permanent reasons. So that's a number that we're keeping an eye on. Right? Again, forecasting being difficult, we can't say with a great deal of certainty whether that's going to continue trending up or down, but that's certainly one metric we're keeping an eye on. Unemployment insurance claims, those have been high for some time, in part because of issues with applying for unemployment insurance. There was an influx of individuals trying to claim unemployment over recent months. Not only because of the additional benefits and not only because of the expansion of those eligible for those benefits, but because of the impact of the pandemic. Going back to work, in many ways, it's a personal decision, it's a monetary decision, right, to some extent, but there are other factors at play as well. I do love spending the extra time at home with my son, but I also love getting out and having some adult conversations at times. So at some point, even though I believe the metric was around 41% of those on unemployment were actually making somewhat more money than they had been before receiving the benefits. I think you're going to see that ebb over time. Even if there were to be an additional stimulus passed, people do want to get back to work for reasons beyond just monetary considerations.
Yeah. And one thing I might add to that I think we forgot to mention as well is that a lot of those folks are not coming back into the labor force because they're caregivers. They're caregiving for children, they're caregiving for elderly family members or friends. And until we open the schools back up and we can send my 4 kids back to school and everybody else's kids back to school, it's possible that they just simply can't work the amount of hours that they did before, no matter what the enhanced UI is.
Okay, all good points, and a lot of discussion around that. So my next question is, we've seen disruption in the supply chain, as we know, in all areas, a shortage of food. In some cases, farmers, we were told, throwing out milk because kids aren't in schools, utilizing, drinking the milk. Produce, car manufacturers stopped making cars like Mercedes and Ford and GM and others to make ventilators, and we're told there's a shortage of cars. HVAC companies are having a difficulty getting parts to repair air conditioning units, whether it's commercial or residential. Share with us your thoughts on kind of the short-term and maybe longer-term impact of all of this on the supply chain. Dan, do you want to take that first?
Sure. This kind of goes to what I was mentioning earlier. Anytime we have a disruption like this, it's really the companies who can adapt quickest are going to be the ones who win. And right now we're seeing that the largest companies with the most access to technology are the ones who are winning. What we probably see from a longer term perspective is that those supply disruptions are alleviated through technology, through adaptability, but also because a lot of companies are going to be, and this is happening for a while, they're going to be trying to do more automation. They're going to be trying to take that human element out of the production and out of the supply chain as much as they can, because if we have another pandemic, if you are more automated in terms of your supply chain and your manufacturing processes, you don't have to be as concerned about a pandemic as somebody who does otherwise. And so for better or worse, if you're a worker, that's really tough news to hear. But if you are involved in that supply chain, that's a upside risk to whatever that next pandemic might bring to us, or whatever the next economic downturn might bring us, separate of a pandemic.
It's being prepared.
Absolutely.
And these are trends that have been occurring before the pandemic, right? Like many things, like many of the changes that we've witnessed during the pandemic, rather than a change in trend, it's been an acceleration of pre-existing trends. And people were starting to diversify, businesses were starting to diversify supply chains well before the pandemic struck. They were starting to diversify supply chains well before even the tariffs on China, right? They were trying to implement automation to make things more efficient, right? So this is really just an acceleration towards the trends that had already been occurring. So in terms of going forward, some of the numbers that we keep an eye on, we look at producer prices, right, which haven't become that elevated to the extent that they would indicate supply disruptions. I know for certain businesses that they may be feeling the pain a little bit more than others, but on an aggregate scale, which is what my team focuses on, we focus on the macroeconomy. We're not necessarily seeing those signs yet, but that's not saying we're not trying to pay attention to when signals might start popping up.
Okay, so interesting. Maybe we could kind of drill down a little bit further on that as far as maybe some industries with some of the disruption where maybe workers won't be going back to work in their industry. So for instance, we're hearing, just even kind of thinking out further as far as manufacturing coming back to the United States, and thinking more globally with the global economy and what's the impact then on China's economy. And we've kind of helped create their middle class, if you will, because we're buying televisions and steel and socks and things. So what might that look like if you have some thoughts maybe more globally as far as trade and what have you, and if the economy dips a little bit, I know it's doing well in China today, but if it dips a little bit because manufacturing is coming back to the U.S., what does that look like longer term, if you have some thoughts?
Well, I think that's a great point, Cam, because I think there is some upside to this. I'm going to it's an easy time to do doom and gloom, because
sure, of course.
There's a lot of doom and gloom, but one of the upsides is that this is going to bring some manufacturing back to the United States as well, because a shorter supply chain makes it a lot easier, or a lot more difficult to disrupt it. So I know the president has talked a lot about manufacturing more drugs and things in the United States, so for national security reasons. For practical reasons as well, if you can limit those supply chains, we may not necessarily bring them back to the United States, but if we can bring them back to Canada or Mexico, I mean, that's a plus from where we were a couple of years ago. So there is some major upside there. Longer term, people tend to forget things very easily, and so we might revert back to some of the trends that Andrew was talking about, but near term, there's definitely some upside.
Interesting. Do you have some thoughts on that?
Yeah, so in terms of the U.S. economy, it is an open economy, but it's more closed than most people understand. Trade is not a huge proportion of our output. It doesn't factor in as much as it does for other major developed economies. Certainly doesn't factor in as much as it does for China. So trade hasn't always been a big engine of our growth or a big impactor on our growth. If anything, it's been a detractor because of all the imports. Looking forward, the U.S. economy, many times when the U.S. economy enters recession or slows down, so too does the world economy. So I think longer term, it's important to keep an eye on, consumers driving the U.S. economy. So I think consumer behavior is going to go a long way towards dictating, how the U.S. goes and in turn how the world goes. So I'll bring things back again, even more so than the supply constraints, which again we're keeping an eye on, or the increasing or decreasing levels of trade. I think, again, particularly in the near term, it's going to come down to consumer behavior, right? And the behavior of businesses, the willingness of businesses to go out and make changes to their supply chain, increase or decrease production, consumers to go out and purchase or act in the ways that they had in the past. So I think that's really a much bigger factor in the near, hopefully not long term, to keep in mind.
Okay, thank you. So if we look back going to the tougher part of this year in March when COVID really kind of came to a head, if you will, and we saw what happened with what we call in our industry the black swan event of the stock market, and none of us have any control. Of course, black swan events, you don't realize they're even coming, and then boom, they're here. And then we really had a second black swan event with the oil crisis just like 2 weeks or so later. Mm-hmm. So maybe you could speak to that just a little bit, the impact of oil prices on the economy, at least now for the near term and even longer term, and where you might see that going, and what is that the impact on our economy?
So I think oil prices, talking with our oil analysts at Vanguard, they got hit doubly, right, with the increase in supply, right, that OPEC had been in negotiations, OPEC +1 with Russia before the pandemic started, and that kind of coincided with the pandemic spreading to developed economies. And then you start to have an impact on demand. Longer term, to put a pinpoint estimate on oil prices, I'm not comfortable doing that, but I would say it's somewhat higher than they are right now. Mm-hmm. I don't know that $100 barrel of oil is likely persistently, mm-hmm. but I also don't believe that $30-40 barrel of oil is likely to persist. Right? You hear all these stories about, particularly the OPEC nations, needing around $80 a barrel to balance their budgets. They've been trying to move away from dependence on oil for some time. They've been trying to diversify their economies. So as that happens, that price that they need to maintain is going to continue to come down. And it's only going to benefit them to keep prices even lower, to try to force out some of those higher cost extraction methods. So I think longer term, oil is likely to be somewhat higher than it is today, but certainly not persist north of $80 a barrel.
Okay. Dan, do you have some thoughts around that?
I do. In terms of the impact on the U.S., it's a very different picture than it was even 10, 15 years ago. I mean, if 15 years ago we had said oil prices were going to be $34 a barrel, everybody would be ecstatic, right? Because most of the country still benefits from lower oil prices. But there are big portions of the U.S. economy now. We've increased our production so much that really are impacted negatively by that. And so it's not a universal exclamation of hooray every time we have low oil prices. So if you're folks in North Dakota, in Oklahoma, in Texas, New Mexico, there are some companies that are really hurting right now in those states, and they have really well-paid workforces that are all of a sudden out of work. Or at much reduced incomes. And that is going to have lasting effects on the U.S. economy, not just in those industries, but on all the supply industries that go up into that. So the manufacturing we're talking about with steel and things that go into fracking in particular, that has major repercussions for the economy. And so to add that on top of this black swan event like you're talking about, did a lot more harm than we would have normally expected to see 15, 20 years ago. And as we continue to see, the U.S. producer be more or less the swing producer globally, we're going to continue to see more volatility in our economy as a result of that. It's something that usually only Saudi Arabia and some of those other countries had to deal with. It makes a difference on our GDP now. Fortunately, it's not a make or break for our economy, but it certainly has a negative impact on the recovery that's to come.
Okay, thank you. So we've just received one or two questions, so I'm going to pose, and we want to thank our members for sharing. So the question from the audience is, what industries are the most unprepared to continue working remotely? So Yeah, Drew, do you want to take that?
You know, I'd say the services industry. You know, I had tickets for the first time ever to an opening day baseball game at Citi Field. I was not able to go. They're hurting. Not saying that professional sports are hurting, but the employees, right, of those types of industries, they're hurting. You know, I have a friend that you know, worked in down at the Wells Fargo Center. He's an operations manager. Spent a good portion of the first few months of the pandemic having to furlough workers, having to have very difficult conversations, and then he himself got furloughed, right? So I think it's going to take a little while for those face-to-face services to come back on. Hopefully it occurs sooner than later, but again, that's going to come down to health outcomes, consumer behavior, you know, retail, right? Whether that's in-store retail or online. I'd say online stands to benefit. You know, the grocery stores dropping groceries off at Dan's house. You know, they're going to do just fine because they have other methods of getting their products out there. But those retail industries that may depend on face-to-face services or face-to-face interactions, those are likely to face struggles longer term.
Yeah, I would agree. I think so. Retail in particular, they're going to do fine, but it's the type of retailers that are going to do fine versus some that are going to do really not fine. There's jobs out there in retail, but they're not the jobs that were there 6-9 months ago. The one that I'm really concerned about, especially here in Chester County, is the restaurant industry and the overall hospitality industry in general. We've been able to make do throughout most of this summer with outdoor seating and all of this stuff, but you know, it's starting to get a little colder, you know, and I think every propane heater in Chester County is going to be gone within a month because people are going to be sitting outside when it's 40 degrees just so they can be out and about. That's not sustainable in our type of climate, and so, you know, parts of the country are going to do fine, but the Northeast in particular, there's a lot of restaurants that will not make it, and for Chester County, that's, you know, really a travesty and something that we need to be paying a very close attention on.
Agreed. That was something that I personally hadn't really given a whole lot of thought to, and evidently those propane heaters are already difficult to get, if at all. So you didn't really think about, gosh, when it starts to get cold and it's too cold to sit outside, they can't accommodate as many people, and our restaurants really can't afford to continue on 25% capacity, so it's really difficult. So we have a second question from our guest this morning is, Congress is debating a Phase 4 relief bill. From what you've read, what elements would be the most helpful to stabilize or grow the economy? And is something missing that you think they should include? So it's kind of a two-part question.
That's a great question.
So the new relief bill, what elements are the most helpful to stabilize or grow the economy? And then what are they missing potentially?
I think the absolute necessity is enhanced or more PPP funding. So that program has been among the most successful fiscal stimulus programs I think we've ever seen. And so extending that out for an extended period of time is going to be huge, and especially as we go through the winter months and we talk about some of those restaurants and small businesses that really need that kind of support. Enhanced UI is important, but certainly not to the extent the $600 a week that we saw before. And then the other piece that's very important, and this is very important for us here in Pennsylvania, I think a lot of people are overlooking it, is the enhanced aid to states and local governments. We are one of many states who are very unprepared for any type of economic downturn, let alone the one we have. And as we put our budgets together, where if the federal government doesn't give them more aid, they're basically daring local governments and state governments in particular to raise taxes. And this is not the time that you raise taxes when you're in the middle of a pandemic like this. But without any additional aid from the federal government, we almost have no choice because we can't cut our way out of this because we're in such a large hole. So we have to have that aid. If we don't have that aid, expect tax increases not only at the state level, but especially next summer when we start to reassess property taxes. That could just be, you know, a terrible, terrible blow to the economy right as we're kind of coming out of this with a vaccine. And so without that additional aid from the federal government, we're sunk. So we have to have that, especially here in Pennsylvania.
So I'd echo the comments about state and local governments, you know, that being a big concern. I would also say, you know, speed always has to be a key element, getting the money in the hands of the people and the businesses that need it as quickly as possible. And also focus. You know, focusing on those industries that are being hardest hit. I know that hasn't really been done to date. It's been much broader than that. And I would also say, you know, that the structure of the plan, structuring the plan in a way that it tries to reduce the amount of unemployment. Right? Unemployment is one of the one of the biggest indicators, or rather one of the factors that's really going to dictate, just how fast we rebound from this. I know that we're going to see very strong growth in Q3, likely somewhere around 20%, if not higher, but that's not going to persist, right? At some point, we're going to have to take a step back and assess the damage done, right? And that damage, particularly to households and household balance sheets, is really around unemployment. So any program that focuses on maintaining labor force, so you get this loan or you get this grant, provided you maintain your labor force at X level, whether that's pre-pandemic level, whether that's current level, whether that's some unemployment rate that the government's willing to tolerate going forward. They have to hinge benefits on trying to keep people, if not employed, at least on payrolls. Right.
Okay, thank you. So we have a third question from our members and guests this morning. Our county, Chester County, has a business recovery task force. In general, what can a county or region do to help the economy in the midst of state, national, or international factors or realities?
I would say personally, I probably know more than I would covering the muni market, but I would say personally, understanding your county, right, and pressing for those needs that would help you on the tail end of this. I mentioned before, assessing the damage, have an understanding of the industries in your county. Understand that if restaurant workers or restaurants are a big part of the GDP in your particular region, try to focus benefits on them in some way. Face-to-face services are a big provider of output for your particular economy. You're going to have to do more to try to get as much funding as possible, because those are the industries that are likely to suffer, hopefully not long-term damage, but certainly near to medium-term damage. As again, I keep going back to this, but it is so important. And you mentioned this at the outset, consumer behavior, people's comfortability going out and spending and behaving like they had in the past. Again, a vaccine would be great, but even a vaccine is not a cure-all, right? So it's helping people get comfortable going back to work and back to their daily lives.
Yeah, and to that, I would only add, helping your populations and your businesses especially navigate all of the different grants and aids that's out there, right? So making sure that people know how to sign up for a PPP loan, making sure that people know what aid is available from the state or the federal government, making sure that people are being routed into the right programs to make sure that they're getting a full extent of that aid. That aid's out there. I mean, whether we like it or not, sure, the state and the federal government are offering a ton of aid right now, and they should be doing everything they can to make sure that as much as possible goes into Chester County.
It's that efficiency. Right?
Yes,
efficiency
absolutely.
So on that note, Dan, thank you, and Andrew, I'll put a note in for, a plug-in for the Chamber, is that the Chester County Chamber of Business and Industry and Guy Shiraki and his team have done tremendous work going back to March in the midst of all of this, helping the members get access to banks and PPP loans and PPE, so that, and, restaurants, they've just done a tremendous job of supporting the economy in our county. So thank you for that. Our fourth question from our guest is, as Congress debates Phase 4, whether it's going to be 1, 2, or 3 trillion in new spending, is there a point where government risks spending too much in relief, causing too much debt? And could that cause more harm?
So personally, I want to be that concerned about the debt issue in the near term. I think that's a longer term issue, right? As we're trying to navigate this pandemic and this recession and the recovery, you don't want to tighten the taps now, right? That's a longer term consideration. Certainly there are going to have to be spending cuts in some areas. There'll likely have to be tax changes, right? You mentioned before, even at the local level, right? But this is a period now where you have to do what you can to get through to the other side of this. Before you start thinking about how to address the debt issue, which is an issue that needs to be addressed longer term. Just how quickly the U.S. government, in part because of our standing as a reserve currency, has a little bit more leeway than a lot of other countries, even those with hard currencies like the Eurozone, the UK, what have you. So we have a little bit more rope, if you will, to work with. So. Debt to GDP likely to come out somewhere around 100% in coming years. There is no one level of debt that is a switch for growth, where all of a sudden growth starts to decline. It's really more country by country specific, and it depends on a lot of factors. I would certainly be more concerned about getting us through to the other side of this than about the level of debt right now. In terms of the amount of stimulus, our own personal forecasts are factoring in around $1 trillion in additional stimulus. If there were to be more, much like you saw with the tax cuts, certainly there would be a boost to growth, but we worry that that could be a sugar high, where you have near-term benefits, but then longer-term that starts to become a drag. So around $1 trillion is factored into our outlook right now. If we were not to get anything, that could shave around 2% off of our GDP forecasts for Q4 and the first half of next year.
I would agree with Andrew that that's something we worry about more in 2 to 3 years than we do immediately, but it's something that whoever wins on November 3rd needs to start thinking about now, because, and I speak out of this because I have 4 boys, and I did the math the other day with the new CBO projections. When my son is my age, the debt to GDP ratio in the US under the best case scenario will be 180% of GDP, which is insane. So unless we get off of that track, we're in big trouble down the road. That said, we need to have fiscal stimulus now. But I think most people would advocate for having just as much as we need and very little more if we can. So I don't think this needs to be $4 trillion, it doesn't need to be $3 trillion. I think our baseline at Moody's calls for $1.5 trillion, which is a lot on top of what we've already done. But when in doubt, you always give just a little bit more in these situations to make sure that the economy can grow its way out of it. But then it's key to make sure that you're getting back on a fiscal path that's sustainable afterwards. We have made huge mistakes in the United States in the past where we've gotten out of the immediate crisis, and the saying in politics is let no good crisis go unused, right? We have to make long-term changes immediately after that, or it doesn't matter how much stimulus we use. It could be 10 trillion. If we're not going to make those changes after the fact, we're just as screwed either way.
So those are all good comments, all good points. That kind of is a good segue into interest rates and where we are with the Fed. We're basically at zero, near zero. What does that look like longer term, and the inability to increase interest rates because of the debt service that we're carrying in our country, and what that might look like, pardon me, longer term, and the impact on banks and revenues. We've seen that the bank stocks, were pummeled over this last downturn of the market, and still, are probably negative 18% in many cases, still up from negative 44% in some cases. So, what does that look like for interest rates, and then even for the banking industry, yields, all that?
Well, the Federal Reserve has said pretty decidedly that rates are going to stay roughly where they are until 2023, and I would believe them. I would take them at their word. Several past Fed chairs have come out and said that one of the biggest mistakes we made was raising interest rates too quickly coming out of the Great Recession, and so I think if they err, they're going to make sure they err on the side of keeping them too low for too long and potentially having more inflation than the other way around. Mm-hmm. So I wouldn't expect them to be too tight too quick. And quite frankly, I think that's a positive. I mean, it's a negative for some portions of the economy, but it's going to be a positive for the next 2 years. And it's an upside risk with that debt, because if we're issuing that Treasury debt, long-term Treasury debt at the lowest rates we've ever issued them at, it definitely softens the blow of the debt service that we're going to see over the next couple of years, or the next 20, 30 years to a certain degree. So that's, I think, some upside, and I would encourage them to keep them as low as they can for quite a while. Yeah.
And again, I would also take them at their word. Taper tantrum was summer of 2013, mm-hmm. I believe, when Ben Bernanke, I believe it was in front of Congress or at his press conference, talked about the idea that the Federal Reserve was thinking about discussing tapering asset purchases at some point in the future, right?
I remember that.
Just mentioning that was enough to send interest rates up 100 basis points over the next 3 months. So what the Fed is doing right now is they're trying to get the public institutions to buy into just how low rates are going to be for how long, right? In kind of a nod to the taper tantrum and his predecessors, Chair Powell said that the Fed was not even thinking about raising rates right now. So rates, on their summary of economic projections are at the zero lower bound through 2023. There's a few governors in there on the fringe that might have somewhat higher, and in some cases rates somewhere around north of 1%. Those are outliers. You know, I would believe the Fed and think that policy rates are going to remain at the zero lower bound for some time as they continue to navigate this crisis and its after effects. And certainly they don't want to be charged with, you know, raising rates too soon. You know, they'd rather err on the side of caution. And they've also made that clear with their new approach to average inflation targeting, right? Where they've always been alluding to this, but now they've come out and explicitly said we will tolerate above 2% inflation for some time. You know, that's explicit now. In the past, people had just sort of had to read between the lines. So going forward, you know, their mandate is for maximum employment and stable price increases. Now, stable price increases would include prices somewhat over 2%. We're not talking about 3, 4, 5%. We're probably talking about, you know, 2, 2.5%. Maybe somewhat lower than 3% for a period of time. And that's important because that means if we get those rates of inflation, that means that consumer behavior, you know, that you brought up that is so important, has switched back, right? And people are starting to go out and spend more, right? The concern I think a lot of people had about inflation are really supply driven. You mentioned some of the issues in the manufacturing sector. We just don't see that being a big driver just yet, but it certainly is something we're keeping an eye on. So we would like to see the Fed keep rates lower for longer. We would welcome inflation of 2% or a little bit north of that. You know, that would be a good sign in our eyes.
Good, agreed. So our next question is, what is the biggest economic issue or cancer that we aren't talking about?
Well, we're economists, so we talk about all of them all the time, so it's tough to say. I would argue that if we're going to use cancer as a analogy, which is a pretty strong choice of words, I would bring up that debt again. But I think because it's a long-term killer, it's something that kills us in 20, 30 years. It doesn't kill us in 2 or 3 years. Yeah. And the inability to find the political will to get us back on a structurally correct path after this immediate crisis is over. I just don't see it happening very quickly. Something catastrophic is going to happen for us to get on the right track there, and I'm worried about what that might be.
So outside of the debt overhang, which I would definitely agree is an issue for us in many economies. You know, we started to bubble up after the GFC, and it's only accelerated as one, you know, following the pandemic. I would say income inequality, you know, not necessarily a cancer, but certainly something that has really been at the core, you know, in our view, at some of these uncertainties, if you will. You know, the increase in populism, not only here in the U.S., but abroad as well. And with that has come a great deal of political uncertainty. You know, I'm not going to use the old line that markets hate uncertainty, right? Because times are always uncertain. You know, we're economists, so we know how uncertain forecasts are. That's why we put error bands around any of our projections. But I think going forward, you know, if income inequality, certainly rising income inequality, continues to be an issue, we're likely to see the political pressures that come with that, and in turn the uncertainty and what effect that has on consumer behavior and businesses.
Okay, good. Yeah, and I think in our office in wealth management, we're getting the same questions from comments or from clients that, hey, Kim, we're not as concerned about today. We know a vaccine is coming, but what is the longer term impact on the economy and everything with the amount of debt that we're carrying? It's one thing to have personal debt, corporate debt, but then government debt around the world. So that's a pretty common question. So our next question from our members and guests today is, looking ahead, what do you think the unemployment rate in the United States and Pennsylvania will be by the third quarter of 2021? So third quarter next year.
Go ahead.
I was going to say third quarter 2021. I think we have it somewhere around, if I remember right, somewhere around 5 to 7% for the broad economy. And the Pennsylvania, if I'm not mistaken, usually hovers a little bit below that. So 5 to 7 for the broader U.S. economy. Call it 4 to 6 for PA.
We are less optimistic. I think we still have things up about 8-9% this time next year. And I think a lot of that is because we do see people start to re-enter the workforce, and when the workforce goes up, we see the unemployment rate naturally rebound a little bit. So I'd be hard pressed to see the unemployment rate be much lower than it is now, about a year from now.
Okay, thank you. So for those of us lucky enough to be able to work from home and maintain our income, what role and responsibility do we have on the economic recovery, or to enable the economic recovery?
Well, keep working, that helps.
Yes.
Keep earning money, that helps. But I think the other thing is to keep, this is going to sound like 2001 all over again, keep spending money. I mean, this is a consumption economy. And to the extent that people get scared and they pull back, that can create additional economic distress on its own. Now, it's difficult to say that, but we've seen it in the data. I mean, the people who are maintaining their incomes, their savings rates are going up considerably. They took those stimulus checks that everybody got and they put them in their savings account, or they put them against their credit cards, and they didn't spend them much. Which is one of the reasons why I think we can't overstate the need for additional fiscal stimulus maybe going into the holiday season, because if we don't see that anywhere close to our normal level of spending, it can, it's going to have ripple effects throughout the rest of the economy.
I would say, similar comments, try to behave as you did before in terms of purchasing to the extent that you're comfortable. My wife and I, we go out to dinner every now and then. We sit outside, we do what we can. We order food quite a bit. Support your local businesses. I know that a lot of them are struggling right now. Very, very difficult for them. A lot of them depend on face-to-face interactions. So the extent that you're able to, go shopping outdoors, or be one of a very few number of people in a store and still go out and make those purchasing decisions that you had pre-pandemic, I think that's going to be very important.
Okay. So our last question for today is just looking at our workforce and, of course, the impacts on the economy of having to retrain people. For some of those industries, or just companies in general, that have decided to downsize or not, they are working efficiently from home, but they've realized, I heard a comment last week, there was a manager of an organization and said, well, we're not going back till April of next year. We don't necessarily need all that office space anymore downtown. Yeah. And by the way, we've realized, gosh, I could do this job with 5 less people in my group. So what are we focusing on as far as retraining people to go back into maybe a different environment to work, or a different industry and skills and what have you? Any thoughts around that, or how that should look like? So
I think it's important. You look at the Nordic countries as an example. They have very strong worker retraining programs. I don't know that exists today in the U.S., certainly not to the extent that they do there. But I mentioned before income inequality being an issue longer term. That's one of the big drivers, right? Certainly if you don't have an income, that's an impediment to, or increases income inequality if a large number of people don't have an income. So getting people prepared for new jobs, I think, is going to be paramount to helping to, usher the economy along, on the other side of this pandemic.
I think that kind of an issue is less of an issue with people who are working from home and people who are working remotely, and more for the people who, maybe were working in person in a factory or in a skilled trade or something like that. And I think that's a problem we've been running into, as Andrew was talking about it. That's a challenge we've had for some time now. And so we just have to double down on some of the job training programs I think that we have. In terms of the people who are working from home, I think that's more of just becoming reaccustomed to the way we're going to have to work from now on. And I think that's just a lot more flexibility. I think you see office buildings that are more just big conference centers at this point, because if you're going to sit in your office and write a paper, you could do that at home, right? If you're going to be interacting with colleagues, which is the reason you'd go into the office in the first place, or clients, that's going to look a little different. So I think there's going to be a lot more flexibility in the workplace. I know a lot of businesses have been very hesitant about that in the past, but a lot more flexibility. And I think from a commercial real estate perspective, that's the biggest risk, I think, behind all this. And we've talked, we do a lot of work with counties and local governments at Moody's, and what they're concerned about, especially the large cities who have a lot of commercial real estate that make up their property tax base. That's a major, major risk over the next 2 or 3 years. So how that all pans out and how people make use of that space, even if it's on a temporary basis, is going to be key to the recovery going forward.
Okay. Well, thank you for that. Before we turn it back over to Guy, I'll just ask, do either of you have just a final comment, final thought of something that maybe we didn't ask you today that you might want to share?
I would just add to the follow-up to that county question, I think another thank you to CCCBI and the stuff that they've been doing, because without groups like this, there would be so many more businesses that would have had so much trouble, especially navigating the PPP portal and everything like that. That continued work at the local level to make sure that that money is being flown into the county as much as possible is we can't do without it. So thank you guys for doing that.
Yeah, I would echo those comments. You know, work being done by groups like the CCCBI, you know, helping to increase the efficiency of those programs, you know, get people access, making sure it's going to the right businesses. You know, the federal government can enact these policies, but they can't get it in people's hands as well as local leaders can. You know, and in terms of comments, I would say, you know, a lot of this depends on health outcomes, you know, not only, you know, death rates and case counts, you know, but just people's comfortability. The arrival of, you know, better understandings of how the virus spreads, the arrival of treatments, eventually a vaccine, and communication from leaders about how to be able to go out and shop, you know, safely, to be able to go out dining safely, to go back to work safely, right? We need to have frameworks in place. Otherwise, there's too much uncertainty, right? Consumer behavior, business behavior. That's going to be key to the recovery, because it's been behaviors that have been changed so significantly this time around as opposed to other recessions. But in order to change those, I'll go back to the health outcomes point. So we really have to pay attention to those and try to increase those and make those as good as possible.
Okay, well, thank you. So I'm hearing for the Chamber's next programming is that maybe having some type of a forum to help folks reframe behaviors and how to safely go back out into a restaurant or a hotel or vacation or what have you to support our economy. So that sounds really good. Well, Andrew Patterson from Vanguard and Dan White from Moody's Analytics, we want to thank you both. Thank you for your time. Thank you for your sponsorship. Thank you for the work that you're doing and the data and all that you're doing for our economy.
It's our pleasure.
And I want to thank Guy again and the Chamber for having us here this morning. It's a great program, and we'll continue to look for the education around this as we all move forward together. Turn it back to you, Guy.
Thank you, Kim, and I want to join Kim in thanking our panelists. I very much appreciate all the work that goes into this. I want to thank Andrew Patterson from Vanguard and the team there at Vanguard. Vanguard has been a founding member of this chamber and has had various representatives on our board, has hosted us for many events, and we look forward to the day to being back there to join all of you. I want to thank Dan White, Moody's Analytics. Dan has been a great help and an asset to us here, particularly in our work with the Grow PA initiative. Again, you know, a year ago we were thinking about how to take Chester County's economy and make it a model for the rest of the state. And we fast forward to now, and in many ways Chester County's economy is still running ahead of the state economy and the national economy, but we now have a very different perspective on the outlook on the local, state, and national. And today we learned a bit more about the road there and where the light may be at the end of this tunnel. So I want to thank Andrew and Dan for their thoughts and comments. I want to thank Luke Tilley of Wilmington Trust and M&T Bank. As their chief economist for Wilmington Trust, Luke set the tone today by his opening remarks, giving us a framework of how we look ahead from their perspective. I would like to also thank Kim Brumbaugh for being not only our moderator, but for the work that she and her team at Brumbaugh Wealth Management do, not only in the business sector, but in our community. Almost all of them, in fact, I'm certain that every one of them is not only a professional in their work, but gives back to the community and is involved in organizations like the Chambers and many others. So thank you. Thank you for your service to the Chamber and our community at large. I want to thank Valley Creek Productions for making this happen and our staff for all the work doing it. Again, we are in a new time, and we are putting together new events and presenting them in new ways. And as we wrap up, just a few comments. One is practical. We have a number of events coming up this fall that will be digital, a mix of digital and in person, and those that will be in person. Please check out our webpage and social media. Our next event here at the Chamber will be an outdoor event next October 7th. It'll be Meet the Candidates. You'll get a chance to meet in person candidates running for the State House and State Senate. Talk to them about your concerns, your business, reopening safely, schools, whatever it might be. A majority of the candidates running for State House and State Senate in our region across Chester County will be here. We encourage you to come and join. We'll be outdoors. We'll be able to do it safely and have a good time. Looking far ahead, our annual dinner is November 12th, a little different. There won't be 600 of us at Longwood Gardens, although we look forward to that. But there will be several of us honoring the founders of Victory Brewing and thanking Senator Dinniman as our Citizen of the Year, and we'll be meeting at Victory in Downingtown. Please check our webpage to learn more about that. And a concluding comment, we will continue, as was discussed here, to make sure that our chamber does what we need to do to not only meet our mission, but to answer the call for these times. We will continue to fight for our businesses, to help them reopen safely, to have the information and materials they need, the resources, the PPE, the dollars, and the information. We will continue to help build relationships, be they digitally or in person. We'll continue to look for allies across the state and across the region so that we can regrow our economy at every level. And we will continue to be a connector, whether it's through Zoom or YouTube, Microsoft Teams or what it might be, or in person. We will continue to meet that vitally important role of being there to be a resource and to be a connector and be a champion. But most of all, we need our members to be engaged, and we ask you to continue not only participating in our events, but sharing us your ideas, your success stories, your lessons learned, and how you can help other businesses, and if we can find ways to help you. Together, we will make sure that Chester County's economy is one of the strongest in the nation. But more importantly, we will do our part to make sure that the nation's economy recovers as we look forward to the time ahead. We look forward to seeing you all in person, be it on your computer screen or in person soon. Again, thank our board for making this event possible and all today's participants. Please have a great day and good luck. Take care.